Just a little bit hawkish, right? Putting 50 basis points back on the table. And what we're looking at, though, is everything held. We bent but not broke. If you look at the technical patterns, the uptrend line got severely tested today, but that afternoon rally helped it hold. The 200-day moving average is holding. So when we look on the technical side, there are still supports to this market that have bent but not broken, and still the uptrend from October is intact. So for now, I know we're all waiting. Friday's going to be a popcorn day as we see those jobs numbers come in. But for now, the uptrend is still working. So a little bit of a sigh of relief. We didn't continue down today. Powell walked back 50 basis points. Futures are pricing in about a 2-to-1 now that it's going to be 50 basis points in March, about 42 basis points priced in. So I think the market has absorbed the potential that's happening. Jolts was in line. We didn't get anything else that moved it today. So for us, right now, we're status quo and waiting on Friday.
So, David, if you think that the jobs report is going to surprise, whether to the upside or to the downside, tomorrow's your last trading day ahead of that report. What do you do tomorrow?
Well, I guess
I think
that's for David Zervos.
Oh, sorry. Yes, I think it depends on, honestly, how big of a surprise you think it's going to be, John. And I think, the odds are really that this market, we saw the ADP data, we saw the JOLTS data at 10.8 instead of 10.5. I mean, it's a pretty strong labor market. Everything with weekly, the jobless claims data. The odds that we get something really surprising to the downside seem pretty low, unless it's a real technical story with seasonal adjustments. So I think we have a strong labor market. We know we have a strong labor market. All the anecdotes suggest we have a strong labor market. The market's ready for a strong labor market, and the market's pricing in almost another 50 bips. And then, what we've seen with the 2-year note is, a almost 25 basis point move in the last.
So, David, are you saying that nothing we get on Friday is going to move the market then? Or if it does come in particularly hot, is there something that investors should be prepared to buy or sell ahead of that if you think that's going to happen?
I would say that the market is prepared for a pretty hot number. Unless it's, like another 500,000, which would be pretty epic. I think the market's prepared for something pretty good here. So the odds that is what moves you and everybody freaks out and says, now we need more than 50 seem very, very low. I would be more looking at what this market is telling you about more of the future, which is what is in the 10-year note, what is in the forward break-even inflation data. And the market has still got a lot of confidence in this Fed. The dollar's strong. Basically, the market is telling you that the Fed is going to get this under control. It just may take a little bit longer than many people thought. And that's kind of what I think Powell told you in the last 2 days as well.
Yeah, Victoria, I want you to weigh on this, too, because I could tell you have some thoughts. Do you agree with that?
I think if you look at the bond market is definitely not pricing in that the Fed has it under control. The worst inversion, over 100 basis points between the 2-year, 10-year. The bond market's been inverted since July. I know that typically leads a recession by 12 to 18 months. So yeah, we still have a lag time until maybe a recession hits. But I think if you look, and that's what is so confusing to investors, the bond market and macro is screaming that there's headwinds ahead and things are going to fall off and the wheels on the bus are going away. But then if you look at the equity market, you've seen some continued strength there. You've seen some decent earnings. So you have very, very mixed fundamental technical and macro headwinds right now, and investors are confused. So right now we have a pretty neutral stance. I know that's boring, but at the same point, we're not necessarily overweight equities because we understand these macro headwinds, but we're also not wanting to exit equities right now because we think there is some fundamental reasoning why you should own some of these stocks right now. And right now the uptrend is still intact. So yes, the bond market is screaming problems, screaming recession. The 2-year at 5+, the 10-year, can't get above 10, but that's different than what the equity market is saying. This rally has continued, and yeah, we consolidated in February, but right now we're holding in March.